Hello, everyone. Welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos. Our webinar today is organized in collaboration with the Singapore Exchange. It is the second in a series of ESG, that's environmental, social, and governance investing. And for that, I have the pleasure of welcoming back Insight Provider Kyle Rudden, who will give us an overview of the metrics and materiality issue and debate. We will explore its implications for corporate ESG reporting and ESG investing, and we'll examine metrics and materiality in practice through examples and case studies. Kyle, welcome to the webinar. The first part of the series was a great introduction to the topic, so let's dive deeper today. Feel free to pick it up.
Great, thank you. Good evening, everyone, and thank you for your interest and participation. As Mike mentioned, today's webinar is the second in a series on ESG-related investing and finance. The first webinar covered some really basic foundational concepts that set the stage for increasingly deeper dives into specific issues, and that's what today is about. Topic of this webinar, ESG metrics and materiality, which I will explain, as I will explain in a few slides, might be the single most important topic in this space. I think it is, at least. Before I get into that, though, really quick introduction. My name is Kyle Rudden. I cover sustainability and ESG investing topics for Smartkarma. I've been doing that for about 2 years now. Prior to that, 10 years, decade. So involved in various aspects of ESG investing. ESG investment research, and contributed to developing reporting standards, both GRI and SASB, did some equity index development. But in total, about 12 years dedicated to ESG. Prior to that, I was in more traditional investment research, mainly as a sell-side equity analyst and head of JP Morgan's Global Energy Equity Research Group. Today, I'm going to cover a few things. Good news is we already covered one of these topics, the introduction. The main content, I'm going to cover in 3 sections. First, just kind of put the concept of metrics and materiality as a phrase into context, what it is, why it's important, how it's complicated, and then most importantly, which is the next section, number 2, how it's evolving. The second section addresses ESG materiality from the perspective of reporting frameworks such as GRI, SASB, TCFD. And specifically, it's not going to be a treatise on frameworks themselves or standards. It's more about how they've gone from being part of a problem to part of a solution, specifically through their changing views on materiality. And then the third, and that'll be the bulk of the presentation. The third section, I'll just go through quickly a few real-world anecdotal examples of how this concept of ESG materiality works its way into the real world in terms of ESG alpha, corporate reporting, a couple other things. And then after that, we'll leave some time for questions and/or interactive dialogue. First off, the issue of ESG metrics and materiality. And by the way, I say that as a phrase. The two are basically one and the same, very related. I'll explain in a second the slight differences. But if I use metrics and materiality interchangeably with materiality, it's just basically the same thing. The first section is about the importance of materiality, how the concept is really a cornerstone of ESG-related investing. And as I will address in various places throughout, it's probably the single most critical issue. It's vital to identifying risks and opportunities, and as I will show at the very end, performance on material metrics really does have a significant effect on alpha. The concept of metrics and materiality, again, I'm taking that as a phrase, the 2 words together, is really about what matters, about what ESG metrics, information, key performance indicators, whatever you want to call it, are relevant for a specific context or in a specific context. And then the relative importance or materiality of those relevant metrics in that specific context. Materiality is like other notions of materiality in investing, accounting. Basically, material information is information that would affect the judgment of an informed investor. However, the non-financial nature of ESG does add a small layer of complexity on top of that, which we'll get into. Materiality it's highly subjective and it's multivariate. It's really a function of a lot of things. But I'm just trying to summarize it here and kind of saying that the drivers can be categorized into 3 groups, if you will. First, the approach to materiality or definition of materiality, basically how one defines materiality. Material to what? To financial performance, to the environment, to society, et cetera, and so forth. Have been, I should say, things are changing very rapidly. The two predominant approaches, right? Financial materiality or business materiality, how ESG performance affects the company, and sort of the greater good or societal materiality, how the company's ESG performance affects the outside world. We'll get into those. That's kind of GRI and SASB. And then there are some new concepts of materiality, which is really the crux of this presentation and the middle section. The second category of things that affect materiality is the reporting company, various characteristics of the entity that's reporting. There are some ESG metrics that are almost universally material, but most are not, and materiality varies by a number of things. To some extent, geography, like including cultural nuances, mainly sector, industry, product mix, business mix, product lines, that kind of thing. And in some cases, other company-specific nuances. And the last category, and we'll talk about these some more in a bit, the last category is the stakeholder, or the end user, and the use case. And I'll actually, I'm not going to go through these bullets because it's the crux of the next slide. There are certainly more stakeholder groups than I have on this slide. I mean, these are pretty representative examples. We talked about materiality being what matters. It's about what matters to who and why. There are a number of stakeholder groups. Here are a few examples. Governments probably interested in ESG performance. I'm talking about ESG reporting and performance of companies. Governments being interested in ESG performance of companies from a sustainable development standpoint. They're going to have one view of what metrics are important, what metrics are material. NGOs like advocacy groups, like, for example, environmental groups or human rights advocacy groups, might be interested in the same kinds of ESG metrics as the government entities, but for their own agendas. Getting down closer to the investing level, customers and suppliers, companies, issuers, their customers and their supply chain are constantly assessing one another on ESG. In fact, that's a pretty big part of the GRI framework. And then finally, investors, what we're talking about. And not just investors, but others in the same general orbit, like investment bankers, others in the sustainable finance and investing orbit. And there's often some divergence in opinions on materiality within a given stakeholder group. For example, a pension fund is going to have a much different view of materiality than, say, a trading-oriented hedge fund. The notion of multiple stakeholder groups is really the gist of the problem we're going to be talking about, what's been called colloquially the ESG data problem. It's a lack of consistent, standardized, comparable, and therefore useful ESG information for a given group. Basically, the entire ESG ecosystem, reporting companies or issuers, ratings firms, but particularly sustainability and ESG standard setters, reporting standard setters like GRI and SASB and others. This whole ecosystem has tried to accommodate everyone over the years, and in doing so has failed to accommodate anyone, or at least accommodate anyone really well. The good news, however, is that there is a light at the end of the tunnel, and that is frameworks, the section on frameworks. The reporting frameworks, I'm not going to go through all of them, but the main ones like GRI, SASB, TCFD are a source of that light at the end of the tunnel. They are going, have gone, are going, kind of the last year or so, from being part of the problem, again, that problem being lack of consistency and everything in reporting and data, gone from being part of the problem to part of the solution. And to be clear, I'm not saying that they were a problem that they did anything wrong. The whole ecosystem over the last 10 years, quote unquote, got it wrong, or just it took time to evolve and kind of collaborate and get together. But broadly speaking, there are two things going on here. First, standard setting organizations have been collaborating over the last year, even consolidating. I mean, SASB, I'm still going to call it SASB, but it merged with IIRC and is now the Value Reporting Foundation. They've been collaborating and even consolidating to simplify things. Long overdue. I've been looking for this for 10 years. Still a ways to go, but it's really encouraging. The second thing that's going on here is that they have been advocating and advancing more modern approaches, if you will, to the concept of ESG materiality. it's an evolution, maybe even want to call it a revolution, that I think stands to fix so much of what has plagued this industry for years. To kind of get a feel, and I'll talk about that in one slide for you, but to get a feel for where we're going, I want to quickly kind of summarize where we've been, and to some extent still are. And I'm going to use the quintessential case of GRI versus SASB to illustrate this. They're the two of the most widely used frameworks. GRI certainly is the biggest in the world. The Sustainable Development Goals by the UN are something slightly different. GRI dominates globally. SASB is a little bit more US oriented. GRI has roughly 13,000 reporting entities using its framework in 90 countries. SASB is only about 273. It might be closer to 300 by now, but orders of magnitude, it's tiny. In about 30 countries, and that's about half US, 50% US, and if you add Europe, it's 90%. So it's much smaller, and US and Europe. GRI is far bigger in Asia. Their approaches are very different. Their approaches to materiality, that is, probably couldn't be any more different. GRI's approach is about societal materiality, or kind of the greater good materiality, if you will. It's an outward-looking view of materiality. It's about the impacts of a company's ESG performance on the outside world, on environment, society, and the economy, but not the company's financials. SASB, or Value Reporting Foundation, is about financial materiality. In fact, incessantly so. It was designed that way from the ground up to be for investors. It's more inward-looking. It's about how a company's ESG performance impacts that company's business operations and financials. And additionally, that financial materiality is sector and industry specific for SASB. So the implications of that, it can be problematic when two criteria are met. When ESG reporting by companies is framework aligned, in other words, they're reporting based upon SASB or based upon GRI, and those ESG reports are being used for ESG related investing. GRI aligned sustainability reports are by definition not financially material, or not about financial materiality. There's a caveat to that that I'll get to. And since GRI is most widely used, most of the world's sustainability reporting falls short of investor needs. It doesn't mean it's useless, but it does fall short. Now, many issuers go beyond GRI, tackle the issue of financial materiality. They can do that by aligning with multiple frameworks, as many companies do. Often you'll see them reporting aligned with GRI, SASB, or maybe TCFD, which is another financial materiality framework. Or they can just simply, by themselves, rather than align with the second framework, they can just simply disclose material that may not be part of GRI, but that they feel is financially material and that investors might want to hear about. SASB-aligned reports kind of have the opposite, or can have the opposite problem. They may be too financially focused, if you will. It's SASB's undying emphasis on financial materiality has two flaws. I mean, one is most relevant here, but I'll mention them both. First, it leaves out a lot of important ESG reporting. An example that really sticks out is that GHG emissions are glaringly absent from many of the requirements for certain sectors and industries, particularly scope 2 and 3. And that's because for those sectors and industries, SASB has determined that GHG emissions are not financially material, but they are still societally material, sustainability material. And the second point that's very related to that is that some of these issues that SASB deemed not financially material 5 years ago, because their standards are about 5 years old now, some of those things have become financially material over time. So in short, GRI-aligned reporting can fall short on investing relevance, and SASB-aligned reporting can fall short on impact relevance. So one solution, as I alluded to earlier, is for companies to report using both, and many do, but there is a better solution, actually a couple of better solutions. And here's where we get into where things are going. Kind of over the last year or so, as I said before, there's been a trend towards collaboration, consolidation, and simplification. And at the center of that is the concept of materiality and new, more modern perspectives on materiality. The binary financially material or societally material approach of yesterday, the one that I just kind of walked through, we'll call it the legacy approach, is very static and it doesn't work. The two primary approaches that are being pursued, and they're so interrelated, they're almost one, but I'm going to address them in two separate slides, are double materiality, sometimes called dual materiality, which is what's on this slide, and dynamic materiality. Double materiality, it quite simply incorporates both financial materiality and societal materiality. So it includes metrics that are financially material and societally material. And those that are both, which is kind of the upper right quadrant of that chart on the right, are, if you will, the most material. They matter financially and they matter for kind of the greater good or sustainability. And then the sort of the bottom right, the three blue circles, is kind of like what I was describing before. That's a little bit more SASB, right? Financial only, or predominantly financial materiality. And the top left is kind of the GRI I just explained before. The real importance here is that it handles both, right? So it's a unification of approaches to sustainability or ESG materiality. And it acknowledges a very important link between the two. And that gets to the next slide, which is dynamic material, the concept that materiality can change over time, or often does change over time. So the double materiality concept from the prior slide acknowledges that societal materiality and financial materiality are interconnected, right? So years ago, like 5 years ago, most environmental metrics were just considered a sustainability thing. Very few viewed them as financially material, but now they are considered financial material. Dynamic material is kind of an extension of double materiality. Basically says that metrics change over time. It can go either way, right? So metrics that are societally material can become financially and vice versa, but it's predominantly about non-financially material metrics becoming financially material. There are a number of examples. I mentioned environmental metrics, but others are like, in a given industry or sector, if you've got an advocacy group, let's say about human rights in the garment or textile sector, if they make a big enough stink about a particular issue, human rights, say in factories, that can become a financially material issue for a company. Couple quick examples just about how all of this is kind of working its way into the real world. First one I want to present is a great study. It's a little bit dated. I think it goes back to 2016, but it is the most oft-cited study. It's by Harvard Business School. It was pretty comprehensive. I can't remember how many companies and sectors looked at, but it's basically global. It basically assessed relative alpha, relative being for companies that performed well on low materiality metrics versus companies that performed well on high materiality metrics. And as you can see, companies that outperformed on ESG metrics that are highly material generated higher alpha, 6%, whereas it's negative 2.9 for low materiality metrics. Again, it's several years old. It's been updated by a few others. The relationships has stayed the same, almost exactly in terms of relative percentages, although the numbers have come down a little bit. I think that top left box now is something like 4.9%. That's one study on how materiality affects alpha. I've looked at pretty extensively, and I'm moving from alpha to sort of events, how, call them ESG events, affect companies and stocks. And in this particular case, I looked at sort of the same kind of concept, how events affected stock where the event was related to a highly material metric or category of metrics. So there are three examples here. Let's just walk through quickly. This is the first one. Two more follow. Chipotle Mexican Grill in the US a couple of years ago had an outbreak of norovirus, just basically rampant food poisoning in hundreds of restaurants, affecting hundreds of customers. And for restaurants, product safety, food safety is a major, highly material ESG issue. I think SASB calls it product safety and customer welfare, but it's basically the same concept. They're financially material ESG issues for restaurants, as is labor practices. And in this case, and I think that's why this is one so extreme, labor practices played into the product safety issue because they were basically understaffed, and because they were understaffed, employees weren't doing all the food safety controls they needed to. This is pretty significant. It was a 42% drop over probably a month or so. And that was based on the event news, the initial event news break, but then there were kind of a series of mini outbreaks afterwards. It did eventually recover after about a year, but it was a long recovery. And again, that was due to subsequent food poisoning outbreaks, and again, a highly material metric. Equifax, if you haven't heard about Chipotle, understandable. It's local. Equifax, I'm sure a lot of people have heard about. It's a massive data breach, probably about a couple of years ago. I can't remember the exact date. Leak of really sensitive, I'm talking about financial, personal data and information affecting, it was roughly 150 million people. I think it was like 147 when the count was done. Data security is a highly material ESG metric for financial services, and customer privacy as well. Now, customer privacy isn't necessarily about data breaches. Customer privacy is more about use of customer data, but the two are very related. I mean, the data security issue, I'm talking about the SASB definition of it, is about data security, cybersecurity, whereas the customer privacy is more aligned with like sharing of customer information and third-party marketing agreements, that kind of thing. But the broad issue of customer privacy certainly relates to a massive data breach. And here you see a pretty big initial drop, about 25% on the news. It recovered over the course of a year, and I put recovered in quotes because it didn't quite recover. Ended with like a negative 2% or so, negative 1.5% from the date of the event. The recovery was actually pretty strong given the significance of the breach, due to some other material issues, particularly governance and the controls that Equifax put in place. And then the last one, which I'm sure everybody's heard about, the Dieselgate scandal, where Volkswagen basically falsified diesel emissions data to skirt US emissions laws. Environmental metrics are really not financially material for auto manufacturers. In fact, they're not material at all, according to SASB. I would argue that they're somewhat material, but this really got to various governance-related metrics that are financially material. And this event violated a lot of them. That decline, as you can see, is a lot more gradual. This was kind of more of a series of mini related events over time. But that big drop that you see kind of halfway through that post-event window, and at the trough, it was like down about 64%. That big drop was on news of penalties, if I recall correctly. But it's just that these three examples, and I apologize. After sending this, an hour or so ago, I realized what I probably should have done. I've also done this for non-material metrics, kind of in the same spirit as the Harvard study, and where there were ESG events that pertained to non-material metrics for a given sector or industry. There were significant effects, but they were much less pronounced than for these material metrics. And the last point, really just generally speaking, I'm not going to go into great depth, is regarding ESG reporting and the creep that we're seeing of this double materiality concept. And I've highlighted a number of Singapore listed issuers that do an exceptional job of ESG and sustainability reporting in general, but specifically in addressing both financial and societal materiality. And some do it by aligning with multiple frameworks, and some do it by specifically addressing financial materiality outside of framework alignment. Not all of them use the term double materiality, but they're effectively talking about that. And just kind of sampling Singapore here, but we're seeing that in Europe, which is actually where the concept of double materiality emanated from, and to a lesser extent in the US, which is very, very encouraging to me because it does a couple of things. One, it again unifies the concept of materiality. So hopefully we'll get some more standardization in the industry, and that'll enable companies to report data that's more useful to the investment community. And that the last year or so, and particularly even the last few months, I say the last year or so because that's been the time frame for the collaboration and consolidation, but it's really been at the longest since like last fall. Last fall sometime, I think it was October, SASB backed the EU's non-financial reporting directive, NFRD, which is where the double materiality concept came from. So SASB is signing on. And then in March of this year, GRI endorsed the same concept, kind of saying the time is right to assess the benefits of the concept. And in the same press release, the same statement, GRI actually included wording that used the phrase financial materiality when referring to its 2021 update of its standards. So the trend, both SASB, or I shouldn't say SASB, it's Value Reporting Foundation now, GRI are updating their standards, and they're including concepts of double materiality and dynamic materiality. TCFD, which is really a financial only view of things. And in fact, there are only 3 frameworks that really focus on financial materiality: SASB, TCFD, and the Climate Disclosure Standard Board. TCFD is being pressured to adjust its financial only perspective and kind of adopt this double materiality approach, but and I expect it eventually will to some degree. But we're seeing change from frameworks, and as the prior slide showed, we're seeing change on the part of companies. And having watched this industry go nowhere over 10 years in terms of simplifying things. In fact, I felt over 10 years it was getting worse and worse and worse. Out of nowhere from last year, it's kind of done an about face. And although there's a lot to do and a lot of rewriting of standards, I think that this is a high priority issue for everyone. Over the next couple of years, we'll see what we've been longing for so long, which is more standardization, relevance, and usefulness of what's being reported. So with that, take some questions if you have any, or expand on anything.
Thank you very much, Kyle. I'll start with a question from the audience on the concept of double materiality. The question is, how would the new concept of double materiality affect the conventional way of conducting a materiality study? What would be the kind of questions to ask stakeholders that would integrate the concept of double materiality?
So, I use the phrase kind of new or emergent, or probably both before. It's not entirely new. I mean, it sort of picked up traction with the EU. That was maybe, I think, late 2019. And the phrase double materiality really picked up, or dual materiality. The concept isn't entirely new. A lot of issuers, when they do their from an issuer or company standpoint, when they do their materiality assessment, they are considering multiple stakeholder groups, right? And that obviously includes existing shareholders if they have shareholders, bondholders, etc., and other stakeholder groups, right? Employees, suppliers, customers, community. So many have been in their materiality assessments thinking about, generally speaking, this concept of double materiality, maybe not necessarily in the way that it's been, kind of described and couched by the EU and subsequently by other frameworks, but it's essentially the same thing. I don't think that it changes a lot, other than companies that, for example, report align. I mean, there are some companies that don't even use these frameworks, but companies that report and align only to, say, SASB or only to GRI, and don't provide additional color voluntarily, right? So if they're GRI only and they really just stick to the bare bones GRI, they're going to need to start thinking about, if they want to adopt this concept of double materiality, and if their stakeholders demand it, they're going to need to start thinking about financial materiality. Now, it's important to note that I think I said it, but I just want to make it clear that the static legacy concept of GRI is not about financial materiality. It's SASB about only being financial materiality, is changing, right? They're both adopting this concept, or particularly SASB, but they're both adopting this concept of double materiality. And they've even mentioned that they will be formally codifying that in updated versions of their standards. So we expect new standards from GRI at the end of this year, and SASB sooner or later, probably not by the end of the year, but relatively soon. In addition, GRI is reintroducing sector and industry specificity. In an early version of GRI years ago, it did have some sector standards. It abandoned them, and it's going back to them. So it's going to be a lot easier once GRI gets the new standards out. If it does include concept of double materiality, maybe sector specificity, it'll be easier for companies who are reporting only aligned with GRI to address the double materiality concept. But until then, they just need to make a conscious effort of it.
Got it. Thank you for that. Another question is, how do ESG ratings take into consideration the different reporting frameworks in their end score?
Yeah, I don't know if I know the answer to how, or they obviously use incorporate the data that is reported in a framework aligned kind of way, right? So, again, the majority of companies in the world use GRI, right? So most sustainability reporting, if it's aligned to a framework, is aligned to GRI. The sustainable development goals as well, but that's kind of a different class of framework, right? So we got 13,000 entities in 90 countries reporting using GRI. A lot of the data that ratings companies use comes from company reports that are aligned to these frameworks, but I don't know that they, in any other way, incorporate the framework specifically. I just don't know the answer to that, other than incorporating the data that is reported in alignment with the frameworks.
Got it. Thank you. As concepts like dynamic materiality gain more traction, is there a risk that we'll discover that such factors such as environmental impact, social impact, have actually a smaller effect on markets than we thought initially? And this is kind of going by the examples you mentioned on Volkswagen and Equifax and such.
Yeah, I think there are ESG issues that are, I think I used the word almost universally relevant, that have broad relevance, and there are ESG metrics issues, whatever, for a given sector or industry that will likely always be relevant, right? So, utilities, greenhouse gas emissions is always going to be relevant, and I don't think over time that's going to change a lot. I think where you're going to see it is, like, for example, a lot of environmental metrics that historically have not, the classic example when you read something about materiality is, someone will write that, for example, emissions is not as material for Facebook as it is for, Exxon or something to that effect. I think what you're going to be seeing is a lot of metrics that we didn't historically think of as being material, either societally or financially, for a given sector, like maybe emissions in a tech company, becoming more financially material because investors are demanding that they be more socially or environmentally responsible, or regulations are changing. It wasn't that long ago where financial services and environmental metrics were just like, we never talked about them, but then the last couple of years it's been a really important thing to assess the carbon footprint of investment portfolios. So again, there's always going to be a core set of metrics that's not going to change a lot one way or the other. I think that the general direction of dynamic materiality is from being societally material and not financially material to being both, as opposed to something that was financially material becoming not financially material, although that could happen. But it remains to be seen. It's a again, not entirely new concept, but it's very new in how it's being embraced by all the important players, particularly reporting standards organizations in most parts of the world. Again, a lot remains to be done, but I have just given what I've seen, how quickly a lot of these entities are moving. I the first time in my 12 years covering ESG, have the confidence that the ecosystem, if you will, as a whole, is finally doing something that's going to have a real impact on ESG reporting and thus ESG investing over the next couple of years.
Got it. Thank you for that. Maybe I'll take one last question. Are ESG scores affected negatively if companies are not using these frameworks?
Yeah, so it's a good question. It sort of helps me I'll answer that and that previous question almost simultaneously. I don't think that a lot of the ratings use the frameworks per se, right? They use the data that's reported via the frameworks. But the issue that this question gets to, is one that's existed for a while, and that's there are a lot of biases in whatever, in ESG ratings, rankings, scores, et cetera, and so forth. Some are inevitable, some have been kind of managed and worked out, but one that's been pretty prevalent is disclosure bias. So that is companies that for example, take an extreme example, a company that discloses a lot of information but doesn't perform well, right? Maybe pollutes a lot, might actually score better than a company that does really well but just doesn't report or doesn't disclose the data. Now that's changed. I mean, the ratings companies and the rest of the ecosystem has kind of, again, worked out a lot of these biases and realized that was sort of an unfair bias. But I think to some extent it exists still. I think, and it's sort of based on anecdotal observations, but that it has more of an effect or impact on whether or not a company is rated or is covered, as opposed to what that rating is. I think certainly, the top companies like, MCI and SCI, are not going to overly penalize an issuer for not using one of these frameworks. Not using one of these frameworks probably means there's less data available, and historically that could have resulted in a lower rating, and it might to some degree still, but I doubt significantly. And again, I think it's more likely to have an impact on being rated or not, as opposed to penalizing for not reporting. Now, there may be exceptions to that. Like if a company reports but doesn't do a great job, like, right, you can assess and analyze the quality of reporting, right? Just as you assess and score a company, you can assess and score the transparency and depth and quality of their ESG reporting. And to the extent that a company maybe reports using GRI, but doesn't really effectively address material topics and boundaries and that kind of thing, doesn't identify what issues are material, maybe they're penalizing it somewhere in a reporting metric for quality, but not using a framework per se shouldn't, and I hope it doesn't have any real effect on a score. I think it might have historically, but I think we've gotten past that.
Thank you very much for that. And thank you everyone for attending today and sending in your questions. Thank you especially to SGX for helping put this webinar together. If you want to engage Kyle for bespoke research requests or premium services, please contact your Smartkarma account manager and they will help you out in this regard. And of course, I do recommend that you follow Kyle's profile on Smartkarma so that you don't miss any of his insights as they get published. As I mentioned before, we will have a recording of this webinar in the registration page at the end, and we will also link to the previous part of this series. And stay tuned for future announcements for the next chapters. Kyle, thank you very much once again for being with us and for sharing your insights.
Thank you. And feel free to reach out with any additional questions, big or small, doesn't matter. Happy to talk.
Absolutely. And you can always email us at research@smartkarma.com with any other questions you might have, and we will make sure to pass them on to Kyle. Thank you very much, everyone, and goodbye.